Good morning. Welcome to the IA Global Asset Management quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello, and I'm a client portfolio manager at IGAM. My guest today is Maxime Houde, portfolio manager, thematic investments. Maxime has been a key player in the US thematic strategy since 2017. Today, he leads the strategy with the support of two analysts. Good morning, Max.
Hey, good morning, Rose. How are you?
Doing good. Happy to have you.
Thank
So,
you.
maybe a quick kind of recap of what happened throughout summer, early weeks of fall. We've seen a lot of volatility in stock markets, and the reasons for that were mainly global economic uncertainty, geopolitical tensions, concerns over labor markets, and really also the pace of interest rate costs. Where was the path of interest rates? Today, with Maxime, what I'd like to discuss is the impact of these elements have had on his performance within the US equity mandate, as well as his outlook for the rest of the year. Is that a good plan, Max?
Yes, perfect.
Great. So maybe let's touch on the performance of the US thematic fund. You've had an excellent year so far. Could you tell us about the key drivers of that performance?
Yeah, it's been a good year so far. I'd say most of the outperformance started in the first half of the year. Uh, we've been able to select a company that were benefiting from AI, and that's been a key driver. Namely, like in semiconductor, obviously we were holding Nvidia, but also in industrials and utilities names. So that really helped. All of the outperformance came mostly from stock picking, and that was investing in the company that benefited throughout this team. So that's been a key driver for the first part of the year. And in the second, I'd say the third quarter, what was interesting is the fund underperformed the S&P 500, but that's to be expected because Q3, like you said, was a pretty volatile environment. And actually, what we saw is that technology was the second worst sector after energy. But the barbell strategy in the fund made it so that we were able to perform better than the Nasdaq, for example, but a bit lower than the S&P 500. So that's really a combination of outperforming in the first half by stock selection through our thematic basket, investing in AI and in technology, but also in industrials, in materials, and in utilities. And also doing some good stock picking in healthcare through Eli Lilly that continue to do really well in obesity drugs. And then we transition a bit the portfolio in more defensive territory heading into Q3. So yes, we underperformed slightly the S&P 500 in Q3, but did better than just high tech exposed index like the Nasdaq, for example. So that's really a combination of harnessing performance in the first half and managing risk in the first part of the second half.
Yeah, that was good timing as well with the volatility of the summer. Uh, Currently, where do you see the most potential for finding value within the US stock markets? And I'm speaking about sectors, industry, well, whatever you feel that is relevant at this point.
Uh, I'd say if you look at the broad market, our strategy has always been to find area where our expectation are not reflected in street expectation or in stock market price. And that's usually leading where we expect to see upside earning revision in the future. So there's a couple of area where I'm interested right now. Obviously, I do think we're entering what I would call the second inning of the 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 AI rally or the AI investment cycle, and that's going through. Last year and beginning of this year was all about semiconductor. I do think now it's moving through industrials, materials, and utilities. We need to harness a lot of energy to be able to power those data center, and money is starting to flow through this area. So we're more and more interested in that area of the market. And one of the reasons is that we have this tailwind, but also we do expect to see economic activity pick up because of interest rate going down. So you have a double tailwind for sector like industrials and materials, especially if you select companies that are exposed to the AI power team, I would say. So this area is still interesting for us. We're a bit more cautious on software, and we've been for a while because it's one of the area in technology that has a bit of a question mark going forward because there could be a lot of disruption in terms of business model because of AI adoption. So we're cautious there. The other area that really we see opportunity is consumer discretionary. It's been a tough area for the last 2 years. We've heard about the consumer and how it seems to be stretched, especially the low income one. And so we do expect that because of interest rate going down, we're going to see a recovery in the consumer discretionary space, namely in travel and leisure. We do expect it's going to continue to do well. Housing, that's an area we've been investing for the last month or so through home builder, some industrial company, and even some furniture company like Wayfair, for example. So that's really we continue to like some sector in the AI thematics. But we're also looking in terms of more cyclical in nature sector and cyclically exposed company as we go through this lowering rate cycle. That's going to benefit discretionary. And if you look at history, consumer discretionary has usually been the sector that do the most in rate cycle cuts. So we're bucking on that.
Good to know, like touching a little bit on the new monetary policy cycle, but also sluggish economic growth, but expected pick up for the rest of the year in early 2025. Are you expecting any specific impact on your strategy for the rest of the year or maybe heading into 2025?
Well, I'll just continue to do some thinking on what I just said is that I do think when you have a more of a sluggish economic growth, area that are more growthy or that are secularly growing in the market are in favor. So I do think that's where we're investing most of our money right now, and that would be in technology and industrials that are impacted by AI team, infrastructure spending. So that area will benefit highly. But on the other end, we want to be forward looking and think about which area will turn a corner and start to grow back as we head into 2025. And the impact of interest rate cut start to be felt on the consumer. So that's why we're looking at more cyclical in nature area like consumer discretionaries, truckings, industrials, and even some materials area. So it's really, we're sticking to our barbell strategy, investing in secularly growing areas because that will be favored in a more sluggish economic growth environment. But we're adding a bit of investment in sector that's going to benefit from interest rate cut. And we're also looking to go in a lower market cap size because small cap is also an area that should benefit as we go through this interest rate cut and the economy start to look better.
Interesting. Maybe one last question. It mostly has to do with challenges. I know you spoke about a lot of the macro things that might impact. Any other specific challenges that you're actually keeping an eye on and that warrants changes or a specific positioning within the portfolio?
Yeah, absolutely. I think really since Q3, the market has been climbing a wall of worry. I think we had some question on geopolitical risk, CPI number. Is the economy going into a recession because of the job numbers that we had a couple of months back? And now we seem to be climbing all those steps. And I think the most important backdrop that we've had is that right now we're having a synchronized stimulus of the global economy from US, Canada, Europe, and even now China, which is a pretty good backdrop for the stock market that we've rarely seen. So I do think when you took all of that together, the only step I would say to climb over will be the election outcome, which still create a bit of uncertainty. So I'm really looking forward to the election. It's an extremely close race right now, so that's why there's a lot of uncertainty. So I do think that's the last step that I'm a bit worried about, and we're reflecting this in the portfolio and making sure that we do not invest in company that will be extremely impacted by which candidate win the election. But outside of that, I do think we have a really good setup for a risk asset like US equity.
Nice. Well, thank you so much, Max. Very insightful.
Thank you, Rose. That was a
Thank you.
pleasure.
Bye.